Hi everyone, welcome to another episode of The Naive Investor. Today we are looking at Altium Limited as per request from one of our viewers. So Altium is an ASX listed software company. The company provides PC-based electronics design software for engineers who design printed circuit boards. Looking at Altium's financial data, we can see that the PE ratio currently sits at 111, while that of the industry is only 84. Personally, not only is the PE ratio way too high for my taste, it's also higher than the industry average. Ideally, I want to see the PE ratio of a company to sit between 15 and 35. In saying so, I have bought companies with huge PE ratios before. Moving on to the company's quick ratio, we can see that it is sitting at 2.11, which suggests that the company has enough cash to last at least 2 years at the current burn rate. This is a tick in my book since I want to be sure that the company can last through the tough time ahead. It is important though to know where the cash is coming from. So to do that, we will turn to the cash flow statement. So looking at the cash flow statement, the only positive cash flow component is cash flow from operating activities. This is a good sign as it means the company is making money. However, looking at the change in cash payment versus that of cash receipts, we can see the change in cash receipt is only 6%, while change in cash payments is 18%. Basically, it's kind of saying that the company's spending is growing faster than its earnings. Furthermore, cash flow from investing activities is negative, which could mean the company is spending on research and development, something that is quite important in all industry, especially software and technology sectors. However, if we look at the income statement, no amount is reported for R&D. For me, this is kind of worrying. Cash flow from financing activities show that the company is paying back debt. This is obviously a good thing as debt incurs interest. Ideally, you don't want a company that has too much debt, since creditors can, at the snap of the fingers, ask for their money back. In saying so, since the interest rate is so low and will most likely remain low, I actually don't mind if they borrow some money to expand their operations or invest in new technologies. Furthermore, the company spends a considerable amount on paying out dividends. It has increased from 28 million to 33 million US dollars. Currently, the dividend yield is 1.42%. This is not a great dividend yield, but it is definitely better than keeping your money in a saving account. In those cases, I might as well keep my money under my mattress, less chance the bank blowing it on self-indulgent activities. Historically, Altium has been pretty consistent with its dividend payouts. The question of whether Altium can continue with future dividend payout is a little difficult to answer as this is dependent on its profit. Dividend is a way for a company to reward its shareholders and a strategic way to deal with cash on hand. One of the good things about dividend paying stocks is that it can help the share price from falling too far because as the stock price decreases, dividend yield increases as long as the dividend amount stays the same. In saying so, Altium's dividend has 0% franking. This means you have to pay tax on the dividend at your next tax claim, and this will reduce your effective dividend yield. Overall, the net change in cash flow is positive 12.5 million US dollars, and this is somewhat a good sign. Moving on to the balance sheet, we can see that the current asset has increased from $131 million to $160 million. This represents a 22% increase over the last 12 months. Since it is a software company, the inventory level represents a very small portion of the current asset. This is something that I like about technology and software companies, the low level of physical goods that otherwise can be a burden on your balance sheet. Comparing the current asset to the current liability, we can see that it is quite favorable. Normally, I would use the cash equivalent and receivables only instead of the total current asset to gauge how long a runway the company has. But since the inventory level makes up such a small portion, I am happy to just use the current asset. Next is the company's income statement. Even though revenue rose from 172 million to 190 million US dollars, the net income has actually dropped by almost 40% from 52 million to 30 million dollars. The drop in income can be a result of the COVID-19 pandemic where sales in the US and China have slowed. In the 2021 investor presentation, Altium stated that the decline is also due to tasking divestment and pivot to the cloud. This is a little worrisome when the company is still paying out the same dividend amount of 19 cents per share. Technical analysis of Altium shows that the stock price rebounded from the 50% Fibonacci retracement level, as that level is quite a strong support. This is the same level that Altium experienced during the COVID drop. Again, the most recent drop increases the dividend yield, and this is probably what is stopping it from falling any further. In saying so, there are definitely better dividend paying shares with lower PE ratio. At the end of the day, I am not feeling too confident in Altium to jump in just yet. I suspect that we'll rise to the resistance at the 61.8% Fibonacci level before pulling back even further, possibly to the 38.2% level. Even then, I will look for a catalyst to suggest that the stock can turn around. So I would put this stock on my watch list and review in 1 or 2 weeks or so. And that is it for this episode of The Naive Investor. Please leave your thoughts on this episode in the comment section below. We would love to read them. Also, if you like what you saw, please leave a like and subscribe and share the video. That really helps us to keep the channel moving forward. Please keep in mind, no video on this channel constitute financial advice. Please seek help from your financial advisors. Until next time, stay safe and keep looking for opportunities.